The views expressed in this video are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. My name is Mike Barnes. I am your host, and today we're talking about the continued tensions in Iran. And we've got some great experts to talk to us about it. First of all, Philip Diehl, 35th Director of the United States Mint and President of U.S. Money Reserve. Philip, I'm so glad you're here.
It's great to be back. Thank you very much, Mike.
And we also have Brad Chastain. He is the Director of Education for U.S. Money Reserve. Brad, glad you're here as well.
Happy to be here. Good to see you again, Mike.
I mentioned that we have those tensions in Iran that have been going on for ever and ever, it seems like, and they affect the economy. Philip, I want to talk to you about that and how the Fed and the interest rates are actually affected by these tensions in Iran and the U.S. involvement.
Well, the Fed is impacted by increasing uncertainty, like all of us are, by what's transpiring in the Middle East. And from day to day, the outcomes or the apparent outcomes swing. And those swings have an impact on expectations that the Fed will have for inflation, for GDP growth, the possibility of a recession. If, for example, if oil prices were to spike as a result of tension in the Middle East, as it did last week, then that could raise inflation. Also, there's a possibility that consumer sentiment will shift, and we saw some indication of that during the conflict. And if it shifts negatively, as it did last week, then you have the increased possibility of a recession. So really what we're talking about is the Fed faces more of the same, this dilemma that they have been in for months and months. And that is, which direction is the economy headed? Is it headed toward higher inflation or a resurgence of inflation? Or is it headed toward a recession? Or is it going to find some way between these two extremes? And with the Iran-Israel conflict and the wider conflicts in the Middle East, it's getting harder and harder to tell. All the more reason why the Fed is likely to wait until there's a clear sign of the direction of the world economy.
Definitely a lot of uncertainty out there, and with the geopolitical tensions, gold is actually playing a factor in this. And Brad, could you elaborate more about how gold is playing in this as well?
For sure. For the first time in, I guess it's 50 years since we went off the gold standard in Bretton Woods, we've seen gold pick up its pace as actually becoming part of monetary policy for central banks. For a long time, central banks have continued to hold gold, and they've been acquiring more of it, but actually putting it to use to implement monetary policy is something we've started to see accelerate. We saw it with Russia when sanctions went on them as they attacked Ukraine, and they started using it for trade, even with China, to be able to sort of circumvent the sanctions. Iran has started doing this as well. Iran has a rather unique way that they manage monetary policy. It's very controlled, but what they have been starting to do is their exporters who earn dollars, euros, things that they're sanctioned from, they are required to repatriate that back into Iran and exchange it through official Iranian channels, where the Iranian government has a tremendous amount of control over those exchange rates. And they use it to the government's advantage and kind of redistribute it to key importers and things like that. But with the sanctions in place, they had not been able to bring in those currencies. And so about a year ago, Iran stopped tariffing imports of gold to allow those exporters to start importing gold in order to meet their repatriation obligations. And so now the central bank has acquired a tremendous amount of gold from those exporters and has been using it to engage in their monetary policy. They've been selling that gold domestically to bring Iranian rial out of circulation. It's sort of like their version of quantitative tightening that we might do here in the United States. They don't have a deep and liquid bond market that the like we do here that the Federal Reserve can use, but they're using gold to bring currency and liquidity out of circulation to try to get a handle on their falling currency, because their currency has been struggling a lot. They've been dealing with inflation. So it's pretty interesting because, like I said, for a long time, gold has been within the monetary system and held by central banks, but now it's being put to use in ways that we really haven't seen in 50 years.
Philip, it's very interesting to me that the dollar and gold are reacting differently with the geopolitical tensions over there.
Yeah, that's a very interesting development. For decades, maybe going back to the 1950s, we saw the dollar or treasury rates respond to high tension periods of time when there's economic stress or geopolitical conflict. We see the dollar and treasuries rally because of the flight to safety. There is no safer investment in the world for decades and decades than U.S. treasuries. And so when people get nervous, they run for shelter, and the dollar and treasuries has been that shelter. And gold has played a role in that too, but they've tended to compete with each other for that role, along with sometimes the Japanese yen or the Swiss franc in more secondary roles. What we've seen here very recently is that with the spiking of tension and economic uncertainty this year in the wake of Liberation Day on tariffs and events in the Middle East and events with China, trade war and all this, we're seeing that the dollar and treasuries are not moving like they have in the past. They're not drawing a bid as a safe haven as strongly as they have in the past. Instead, it's the dollar, it's gold that is drawing much more of that role as a safe haven. And we've seen gold prices respond accordingly as demand is increased during those periods of uncertainty. Sometimes when then that uncertainty relaxes a little bit, then we'll see gold prices retreat for a while. But I think the thing and this has been the case not just over the last, it's been more pronounced over the last 6 months, but it's really been the case for the last 20 months of this rally. As these expectations and fears rise and fall, then we see the price of gold rise and fall. But the thing to bear in mind is that throughout all of this, there's been this incredible trajectory upward for gold prices. And we have not seen an end to that. People talk today, this is clickbait. There's talk today about the possibility that gold has reached its peak. In fact, gold continues to rise. Probably about 80 days or so ago, it firmly established the $3,200 an ounce base. And it set these bases over and over again during the course of the rally. And it got up to 3,200, set that base over the course of 5 weeks or so, and then has now risen to $3,300 base, and that's been in place for about 45 days. So I expect it to continue rising.
Everyone loves a safe haven. No one likes clickbait. Brad, with the way that the geopolitical stuff is going on over there, with U.S. investors who have diversified their portfolio into gold, what do they need to be paying attention to?
Yeah, and as Philip said, the gold has reestablished itself really as that safe haven. We've seen very clearly here versus other assets more recently. And I think what people really should be focusing on is the big picture. It's easy to get lost in day-to-day narratives and all of the news going on out there. And there are some really important pieces of that. Things like the U.S. debt and deficit that have implications for gold, the geopolitical conflicts over there. Everybody is well aware that the role that gold can play in those sort of situations. But I think what's oftentimes getting lost, or is completely getting lost right now in the media, is the overall sea change that is taking place, that's setting a sort of a new trajectory for where sort of the world is headed. So if you think about what we are doing right now with tariffs, for example, that's a situation where we're trying to reduce the trade deficit. We're trying to reduce U.S. demand for foreign goods. That's fewer dollars being sent overseas, which have, for the last 45 years, come back into U.S. assets, into treasuries. And in order to rebalance trade like we're looking to do, one thing that has to rebalance is that capital flow, or flow of money into financial assets. There's two sides of that equation. If your current account deficit for a country goes down, or meaning that they're not running as large of a trade deficit, then we also have to see the capital inflows go down as well on the balance of payments. And we've seen that not only with the implementation of tariffs, but also in the newest tax bill. There are provisions to start taxing foreign owners of U.S. assets and income. And that is sort of the thing that's getting largely overlooked right now, that will have a bearing on where U.S. asset prices go, but also the role that the dollar and gold plays in the future. Because what we've seen with countries like U.S., with Iran and Russia, as we just talked about, starting to use gold more and more as a part of their monetary policy, you see that when countries don't have access to dollars, or even if dollars become too expensive during times. And just because we may not be sanctioning everybody else, if we're moving towards this policy of reducing foreign demand for U.S. assets, stop sending as many dollars overseas, it's the same effect on other foreign countries, that they don't have access to the dollars, just like if they were being sanctioned. The reason is sort of irrelevant. And so you're likely to start seeing them move more towards alternatives. And you do see that already, trying to use local currencies a lot more internationally. But we're starting to now see gold pick up that pace, because it can provide, as a neutral asset, support for those currencies and alternative uses to manage that monetary policy. When dollars, traditionally, when a country wants to manage their currency, they will either sell their currency to buy dollars or sell dollars to buy their currency. And if dollars aren't playing that role, because we're literally changing the structure of the system, then it looks like gold is well positioned to move into that place. And central banks have been preparing for this for decades now, acquiring more and more gold. So I think having a gold as a part of a diversified portfolio at this point and going forward is going to be paramount. And I'm not sure that financial advisors have caught on to that yet. Usually they catch on to it after things have happened, and then they go back and look at the way things were, and they say, okay, now this is good. It does not seem like they're really forward-looking and looking at the sort of sea change that's actually taking place beneath the surface of all the news.
Mike, I want to pick up on this crucial point that Brad is making, and that is you can look at the current situation in the financial markets from different levels, the 50,000 foot level, the 20,000 foot level, the 1,000 foot level. They're all telling similar stories. At the 50,000 foot level that Brad is talking about, we're really dealing with a level of complexity that most of us struggle with. And the history of this goes back to the post-World War II era and the entire the financial system that was set up at that time. And what Brad is talking about, of course, is that system is rapidly evolving into something different, and we're not sure what that is yet. But we do know that gold is playing a much more active role as money in that system than it has in the past. It's become a strategic asset for companies. You go to the 20,000 foot level, and you see gold playing this crucial role in like central banks and central bank policies in moving assets out of the dollar into gold for sort of tactical reasons. The same reason why you would sell an asset that you would expect to fall in value, the dollar, treasuries, and buy an asset put in your portfolio you expect to be solid and steady or rise in values, and that's gold. And then we're seeing this happening on the individual levels as well, driven by current events. And that's sort of the day-to-day business that moves the market in macro fashions. And I'll just focus on one example, and that's the most relevant one today that we're all looking at. The news, markets are being driven by a level of optimism that has come out of the bombing of the Iran nuclear facilities. And it looks pretty good. There's a lot of bragging coming out of the White House and out of Israel about what the results of this bombing have been. The reality is that it will take weeks before we have any kind of definitive sense about what the accomplishments were of these bombings, because after all, these facilities were way underground. So it's not easy to see what the impact was. But what we do know, the preliminary knowledge is that we probably set back the Iranian nuclear program by a few months to maybe a couple years. That's all. And so one of three things is going to have to happen if the U.S. and Israel are going to successfully address what they've attempted to achieve. And that is, they'll either have to go back in and bomb again once they understand the amount of damage that they've done, in order to eliminate the enriched uranium that Iran still holds and the centrifuges, or they're going to have to negotiate a deal, and that's going to be tough. Or what we're going to see is Iran try to run and break out and become a nuclear state very rapidly, because they can look at the example of North Korea, and the North Korean example is that once they got nuclear weapons, well, then bombing them did not appear to be much of an option anymore for obvious reasons. Our friends in South Korea and Japan had a vote on that one. And there's even speculation that Iran has nuclear facilities under a mountain in North Korea. And that's from responsible sources. That's not just internet talk. So the uncertainty that the market right now thinks has been removed from the table is anything but. It's going to be back, and we're all going to be talking about this again in the not too distant future.
So many possibilities, and I feel like every level that you talked about, Philip, there are different topics that are affecting us and everything that we're talking about as far as the economy. I want to finish with this. For those of us who have gold in our portfolio, who want gold in our portfolio, what is the biggest topic, what is the biggest factor we should keep our eyes on right now and in the future? Philip, let's start with you.
Well, there's some things that are going to be easy for us to keep our eye on, because they're going to be front page news, and things out of Iran and Israel, certainly in the region, that's going to be front page news. We're not going to be able to ignore that. What I'm sort of keeping my eye on is two things. One is, what is going to happen to the president's one big beautiful bill in Congress? There's a lot of uncertainty about what that is actually going to come out of the Senate, and then what the negotiations are going to be like between the House and the Senate. And if that bill fails to pass by the end of July, markets are going to get real nervous. Not only because there's so much at stake in that bill, budget cuts and tax cuts, but also because the extension of the debt limit is buried in that bill. $4 trillion increase in the debt limit. And once again, as we periodically do, if we don't, we have to be concerned that if the debt limit is not raised, then we begin to face the threat of default on our debt. And for reasons that are too complex to get into here. I think if we got into a situation like that in the current political and economic circumstances, I think we run a greater threat of default. But the other thing I think we really need to keep our eye on is the fight over who controls the Fed. And of course, the president has been very critical and continues to be very critical of Chairman Powell. He's stopped calling for his resignation or saying that he's going to fire him, but he's still highly critical. And there's talk now that Trump's going to may announce his replacement for Powell. Powell's term ends next May. And by doing so, he kind of have somebody looking over Powell's shoulder all the time. Anytime Powell, states a position about inflation or unemployment or the direction of interest rates, then Trump's next guy is going to be saying something different. And that's a nasty scenario for us, because it begins to raise questions about the independence of the Fed, and that's the last thing we need right now.
Factors to keep your eye on. Brad, what do you think?
I think going back to my 50,000 foot view, as Philip put it, looking at how quickly the sea change is happening. So I look at a lot of the things that we see in the news every day. Is if you imagine yourself sitting on the beach and you're watching to see if that next wave is going to take out all your stuff, right? Some of them are bigger, some of them are smaller, but what really matters over the time is what is the tide doing? What is the moon's gravitational pull doing to determine how safe your stuff is? And the gravitational pull right now with what we're trying to accomplish is changing the role that we play in the world. As J.D. Vance put it, not being the world's piggy bank. As Peter Navarro has said similar comments. Pretty much everybody in the administration has said the sort of same thing, that we want that role to change. Stephen Marin, Trump's chief of Council of Economic Advisors, stated that supplying the world with reserve assets that they consistently buy has kept the dollar too strong and has created these imbalances. So I think it's clear what the objective is to try to do. It's not stated very explicitly. It's stated as bringing jobs back. It's stated as rebuilding a middle class. But the other side, that financial account that doesn't get talked about as much, is something to really watch. So I think how quickly and successfully these policies get implemented, because they could easily stall, could easily not move forward at some point, just because political winds shift. But what we are trying to do, if they continue to move forward, it is changing the dollar's role. It will inevitably change the dollar's role in the global monetary system. So I'm really watching that carefully, is how efficiently do these policies get implemented? How effective are they in re-landscaping the global order, if you will?
Brad, I like your view from 50,000 feet. Thanks so much for your insight today.
Thank you for having us. Always great to be here.
And Philip Diehl, thanks so much for all of your insight and telling us what you think about all that's going on in the world today.
Thank you, Mike.
That's all the time we have for today's episode. On behalf of all of us here in the U.S. Money Reserve Studios, thank you so much for tuning in. If you have any questions or you want to learn more about today's episode, you can call the number in our episode description and speak with one of our friendly account executives. They're going to be very happy to answer any questions you may have about precious metals and the strategic role they can play in achieving a secure and comfortable financial future. I'm Mike Barnes. We will see you next time on America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.